Our keynote speakers, Peter Adriaens from the University of Michigan. He's professor of engineering, finance, and entrepreneurship, and he directs the Center for Digital Asset Finance and the Master of Engineering in Smart Infrastructure Finance. Funded by corporations, financial service firms, and foundations, his research focuses on digital business, finance, and data market models for smart city infrastructure, and on using artificial intelligence and machine learning models for climate risk pricing in capital markets. Previously, he was Distinguished Professor of Entrepreneurship at Sichuan University in China and the Research Institute of the Finnish Economy in Helsinki. He's founder of Aquarius Risk Analytics, a financial technology firm focused on corporate climate risk pricing and equities. And so join me in welcoming Peter Adriaens. Just do the slides there, or you can use this thing, and that even will work. You want to see if you can do that?
Hello, everyone. It's pretty tough to talk about finance as the first talk after lunch. That counts for 2 slides out of your 686 slides. Jim, and I'd like to thank Jim and Matt for inviting me to this conference. Actually, I didn't even know this conference or this meeting existed, even though one of my faculty colleagues, Nancy Love at U of M, I mean, she's a member of this alliance. I just wasn't aware of that. So why think and talk about finance in this context? A number of years ago, a couple of colleagues of mine out of the business world and the business school started going to a conference that was hosted by Credit Suisse, of course, a bank that no longer exists, subsumed by UBS. And it was in New York, and it was all about conservation finance. And a big part of that centered around preserving, of course, the environment and nature and agriculture and whatnot. And so they talked about conditioning capital. So conditioning capital for sustainability. And we went for about 8 years to try to figure out what does that mean and how could we use this in the context of sustainable ag or nature-based solutions or things like that. So I'm going to talk a bit, not about the physical world, but about the food chain of money. And why there is an opportunity here to help out the farmers overcome the barriers to move towards sustainable practices sort of beyond subsidies and beyond Farm Bill. And as many of you know, there is still no Farm Bill, right? So we're still, who knows whether there ever will be a Farm Bill again, but we have no idea where these negotiations are going to go. So as Jim said, I direct the Center for Digital Asset Finance. We do have a lot of industry. We have financial technology companies. We got a pension fund involved. Pension funds are very heavily invested in agriculture. And so you start looking at and then foundations and whatnot as well. And it's not just ag that I do. It's really more looking at what's the value of data and information in structuring new funding and financing models. So let's start with sort of the basic premise, and that is that it's not the farmer's fault, it's Wall Street's fault. All right, so that's a good one, so maybe we can all agree on that. But the reason being that the food chain of money that ultimately ends up at the farm originates from somewhere. And it is the risk that is priced in that money is based on some conditionality that is not just credit risk, but has other risks associated with it. So we decided to explore kind of that link between, let me see if this works here. So is this on?
Point at the screen, Peter.
Turn this one off. Yeah, does this work? Yeah, it does work. All right, good. I prefer walking around anyways. So that, it really all starts with, I guess, the agricultural bond market. I mean, a lot of our money for farming comes from there, and it sort of trickles its way down ultimately into lending to the farmer, and of course the farmer, because of maximization of output and yield and whatnot, applies fertilizer to their land. And so we're going to talk a little bit about this context, but let's first take a little bit more detail. All right, here's more detail. I apologize if the colors don't come through very well, but the idea is that, or the information, I guess, on this food chain of money is that basically, if you look at all these different types of money over here, there's industrial, real investors, government investors, asset owners and operators sort of move their money, yeah, maybe it's a little darker, it might show up a little better, like through public equities, through loans and other fixed income and bonds and whatnot, ultimately into the farm credit system. So when we started our research project and we proposed to the Great Lakes Protection Fund, because of in the Great Lakes region, and the Foundation for Food and Agricultural Research, that we wanted to see if there was an opportunity for capital markets to get involved, they were very, very skeptical. They say, well, the money comes from the government. So the money does not come from the government. The government is sort of the answer that all my students always give me. Right? So where does that money for infrastructure come from? From the government. I said, no, not really. I mean, so where does it really come from? So it flows through sort of multiple different groups and types of investors until so we end up in agriculture value chain companies, or the one I'm going to be talking about here is the farm credit system. Of course, farming, 50% of farming, 48% of farming comes through the farm credit system, and maybe about 46% comes through commercial systems, commercial banking and lending, and then the rest comes through farmer mac and life insurance companies. Bank ultimately sits into farmland, or it sits in farm operational capital. So let's break this down a little further. So we're going to go deeper and deeper. So the farm credit system, which is the one that we decided to focus on, because when you're looking at a lot of farmers, I mean, particularly in the region where we are, where we have small farms, I mean, the largest farms are maybe 4,500 acres. This is not Kansas. This is not the large California farms. These are tens of thousands of small farms. In aggregate, of course, lots of acreage, but so they work a lot through the farm system. So basically, institutional investors, so these are going to be, the BlackRocks of the world as well as others, they buy agricultural bonds that are issued by a paragovernmental organization that the Federal Farm Credit Banks Funding Corporation, that's a mouthful, right? So they are the ones that engage about 175 investors to lend the money against an interest rate. That money is used to fund the four farm credit banks in the United States. 4 major farm credit banks in the entire United States. And you see here their coverage. These 4 banks over here. Now they lend their money. So basically that money is used to build their balance sheet. They lend money to the farm credit associations. And these are, for example, in Michigan, that would be Greenstone. Michigan and northeast Wisconsin is all Greenstone. And we have about 7 of them that serve as the Great Lakes. So we're going to go then the second. So then basically that is used, the money is used for mortgages, it's used for operations, and ultimately runs the farmer's business. All right, now let's go a little bit deeper. So there's a total of 7 farm credit systems that support 213 counties in the Great Lakes region. So when we proposed this project to both of the funding organizations, we said to the Great Lakes Protection Fund, we'll go very deep in all of this just for Michigan. And then to FR, we said we're going to use that use case and platformize it out across the entire Great Lakes region, right? So now you're looking at 7 farm credit systems support 213 counties in the watershed. All right, so now we know something about that money. A little bit here on the bonds. So the original money, where does that come from? So this is a typical screenshot from a Bloomberg terminal. Probably not too many of you look at a Bloomberg terminal, but that's something that my students always pore over. And I was like, who's buying what and doing what? So this is sort of distribution, investment managers. I mean, you see 390 billion, right? And then 91% are US buyers, and each of them have different requirements of what the return on these bonds need to be. So let's say, all right, so we have 7 farm credit systems. Now we're going to go further. Out of these 7, you want this one up here for, I mean, the slides are going to be available, I assume, to everyone. So out of all that, about 100 billion, that's a lot of money, is being lent to farmers in the Great Lakes watershed. 38 billion of which is farm operations. So the rest is mortgages to buy more land, which becomes very important, right? Because farmers expand and sell, and there's a lot of trading, and there's right now particularly generational transfer of land and all of that. So that all becomes part of the whole equation. Right? So now we have information. This is actually, because it is a public system, we can actually look at the financial statements and figure out where the money transfer is. So we're looking at 100 billion. All right. So 100 billion in all these 232 counties. All right. Now we can even go dig deeper into this. Remember, we started in the bond markets. We started with BlackRock, right? So now we say about $600 million of loans. This one over here, total loan value. Out of that, 100 billion goes to fertilizer spend. So now we've tracked, right? Follow the dollar. I tell my students, follow the dollar. It's easier said than done. It takes a little bit of poring over boring financial statements. So, but ultimately you sort of get this 100 billion value. Then you have all the counties in the watershed. Then you have the farm operations. And within farm operations, we know the fertilizer spend. And we know which bank or which farm credit system actually holds nutrient emissions on their bill, on their loan bill, right? So if you look at this over here, these are the 7 farm credit associations. Greenstone is the one that services Michigan. See, it's the highest, right? So they have essentially embedded in all that money is essentially eutrophication of the Great Lakes, right? So you can start tying this connection together to the next one. So now, and we don't know that yet until we start interviewing the farmers and do all the inventory on their Form Fs and all of that. And we've just started with all of that because now you need to get the individual farmer. We just followed all the banks, all the way to the counties, all the way to the fertilizer spend. Now we go to the farmers because ultimately we want to incentivize the farmers by changing their borrowing costs, by changing their insurance rates, by changing their asset value, by doing all sorts of different things, right? So that's why we say potential, because we haven't actually taken that from their bill. But if you look at how much is being spent on fertilizer, N&P, then you're looking at sort of the embedded CO2. Well, actually, this is just the N&P. So 42 million kilos of N, 4 million kilos of phosphorus running off into the Great Lakes every year. That's a lot. Is there value in that? I mean, we think of that as pollution. Of course, it is pollution because it causes eutrophication. But is there a monetizable opportunity in this? All right, well, let's take it to the next step. Yeah, it is in here. So now we're drilling down further. So now we're saying, okay, every, say 300, and because we wanted to sort of normalize that one way or another, right? So in nitrogen and phosphorus production, that gets to the farm and that runs off the farm, there is carbon equivalents associated with that. Carbon equivalents have a market price. There's insets, offsets, carbon warrants, all these other things that investors price. An investor at BlackRock does not care about water and nutrients. What they care about is the carbon in their financed emissions. So we need to convert everything into that carbon equivalent. All right, and it's already happening anyways, but so that 600 million total loan value, right? So we say for every 330K in farm fertilizer financing, there's up to 1 million kilograms of CO2 equivalent in nutrient runoff in the Great Lakes. They say, aha, now let's dig a little bit deeper, because can all that all these emitted fertilizers in carbon equivalent be converted in revenue? It's essentially money left off the table. It's pollution, but it's a value of pollution. So reducing this essentially increases the opportunity of carbon value on your balance sheet. So it's almost like you flip the whole thing around, right? Yes, and I think there's a lot of folks here that are working on less synthetic and more natural fertilizer products and whatnot, the phosphorus products, and they're definitely part of the equation. So, but now we're starting looking at, can you just by changing your practice actually capture that value, and it basically makes it back on your balance sheet as diversified revenue. And when we talk to Greenstone, they say, that's what it's all about. Sustainability in the current day and age, as many of you that read newspapers or listen to podcasts, sustainability is way back in their thought process. It's all about resilience in their revenue and resilience in the volatility of revenue of the farmer, right? Farmers are all hoping and waiting for a bailout right now because they can't sell all their stuff on account of tariffs and everything else. So we're looking into monetizing this, all right? So let's take it to the next. These externalities, of course, as we all know, are not priced. And we actually did some work before. This is work by Kenneth Chung, one of my PhD students, and myself. So we looked at all the data from Acre Value. Acre Value is a database that came out originally out of Cornell. And we can actually look at the reselling of property in particular, say, in this region. And we have all the data and all the information, how much fertilizer was applied, how much of it was synthetic, how much of it was manure, how much of it was, how many acres, and all that kind of information is there, right? So we know that basically the more fertilizer you apply, the higher the value of your land. In a way, a land is a productivity asset, right? So therefore, if you're reselling it, you're going to get more value out of that. So that externality is not priced. So how do we bend that curve to make sure that the externality does get paid? We do that through these financed emissions. So basically, depending on what the farmer uses or how the farmer is incentivized, the cost of capital is going to change. So basically, we look at that input in financed emissions. Right? Financed emissions essentially means I'm giving you money, but my money has embedded carbon associated with it, and my money is going to cost more if it has a lot of embedded carbon in it. My money costs less if there's less embedded carbon in it. And we see that price differential is roughly about 2 notches on the credit scale. If you're looking at sort of an interest rate that you pay, high carbon money versus low carbon money, 2 notches on the credit scale. I think any of us would be happy with going up 2 notches on the credit scale to pay less interest, right? So we've been looking at that whole model here of valuing these externalities and repricing the risk. And you reprice the risk, the repricing of risk has happened for years through all these green financing instruments, there's green bonds, sustainability-linked bonds, green insurance, all of that stuff. And a lot of that starts showing that there is a bifurcation in pricing mechanisms because carbon is seen essentially as an embedded fiduciary risk to investors that have to report this to the originators of the money, to the asset owners. So fiduciary risk means that you want to deploy your capital with the lowest risk and the highest return possible. That's essentially what you want to do for your client, right? Pension funds don't have their own money. That's our money. Banks don't have their own money. It's pension funds' money, for example, because banks are just, they're just custodians, right? So everybody sort of has that fiduciary risk component associated with it. So let me skip through this one over here. So, of course, how do we do this? And this is something that is closer to probably what this audience is about, right? Is all these best management practices. The big question is, are farmers incentivized to do so? Well, if you're looking at where we are right now, if you were to ask farmers, we've interviewed lots of farmers, and probably many of you have also, right? So they're fearing about the decrease in asset value, but I just showed you. I'm going to apply less fertilizer. I'm going to have less yield, at least for lower yield, at least for a few years. My land's going to be less valuable. Increased operating costs, potentially decreased. Here's my decreased yields, which result in decreased asset value. Loss of access maybe to farm bill subsidies if you don't apply less fertilizer. On the other hand, what are your incentives? A premium reduction of farm insurance, maybe $5 an acre, something like that. What you're currently getting, farm conservation subsidies, and industry-funded carbon programs. But it's still way out of balance. So how can we bring this thing into balance? All right, so our objective is to do that through 3 different models. And I'm not going to go much and very deep into the results, just in the interest of time. We only have a half hour. Right, where am I, Jim?
1:32, you have 10 more minutes.
Okay, good. All right. So we look at sustainability-linked loans. And so I'm going to talk a little bit about the sustainability-linked loan, what that actually means. It's a concept out of industry. It's a concept that exists, for example, when large corporations borrow from consortia of banks to finance their operations or expand their operations, right? They're all starting to refinance. They're refinancing their current, say, 5-year credit facility based on sustainability targets. And again, they get about a 30 to 50 basis point, so that's 0.3 to 0.5% discount on their interest rate. We're starting to see sort of that the green bonds, it's the same thing. Up to 150 basis points, that's 1.5% difference in a bond that is sustainability linked and not sustainability linked. So the market is really starting to recognize that. Sustainability linked loans, we have to develop a framework as a farmer takes out a loan, an operational loan or a mortgage loan. How do we account for their operations in pricing the risk of that loan? And we actually have an agricultural business breakfast next week with some of the off-takers and the banks to discuss this. Carbon-based asset valuation. We're going to talk about that a little bit as well. What does that mean? Well, I mean, if you are more judicious, I guess, with the type of fertilizer that you apply, how you apply, et cetera, you essentially effectively are storing carbon or reducing carbon runoff from your land. If you're storing it, it has an implied market price. The implied market price means your land becomes more valuable. Right? So which means that when you take out a loan against your regular land or your loan against your land plus the implied carbon value, your loan to value ratio goes down, you get a lower interest rate. Again, so the same thing like that. So we start revaluing land. And then parametric transition insurance. This is something very new. We just started with that with the Walton Family Foundation and with the Rockefeller Foundation. And this is sort of initially came out of Europe, that for 3 to 7 years after implementing sustainable practices, yield goes down. So it's a loss to the farmer. Can that be recouped through a regenerative, I guess, if you will, parametric transition insurance? And so that model, that actuarial model is currently being worked out. So let me go beyond this. So what is our use case? Our use case is the Great Lakes region. 45% of the land is used for ag. 20 to 22 counties. We're just right now initially doing it in Michigan and then expanding it using machine learning. 1.5 million citizens, 15,000 farms. Just Michigan, right? All small farms. And then about 1/5 or so receive, 1/4 receive some form of subsidy. So if you overlay that, so this is an example. It's not easy to actually start quantifying the digital twin, operational digital twin of a farm, because a farm may have 6, 7, 8, 10 different non-contiguous parcels. So we need to actually get that information on each of these parcels that they disclose in their Form F to the government, and we deploy that on a blockchain. And I'm not going to get into the blockchain either. We need to put that also like a big spreadsheet, except for we're using a digital spreadsheet. All right. So if you, for example, now look at, I mean, this is Farmer John here, right? Or Farmer Jim, all right? So he has multiple different parcels. We know what the sub-watershed is. We know how many acres he or she has, I guess, that they're managing. What is their rotation? Which crop do they grow? What do they apply? In nitrogen, what they apply? This is the input, right, on the land, and delivered is basically what comes off the land. Delivered is delivered to the watershed. We don't want that, but that's how it's quantified. Same with P, inputs delivered to the watershed, and the carbon in metric tons per year is being quantified. And that metric tons per year now becomes an implied carbon value that helps Greenstone to reprice the loan to the farmer. Now you would say, why on earth would any bank want to give a loan at a lower interest rate? Well, because Greenstone does not have its own money either. They borrow it from upstream from the big agribanks. So now they can get discount from the agribank on how they lend. Right? So it's sort of, that supply chain of money is all now conditioned. It's all getting conditioned. Right? So that's why there's that bifurcation between green and brown loans. I don't want to go into all the technicalities. There's a lot of groundwater modeling. There is a lot of digital twin buildup. There is a lot of carbon asset valuations. And I'm just going to go through just quickly one of them, an example here, carbon-backed lending, right? And then I'm going to wrap it up with that. So let's say on average, right, wheat, this is Great Lakes region, that's US. We have our yield in bushels, price per bushel. Of course, that changes too. It's just an average price over here. So we have a gross revenue per farm, I mean, particularly if they're, I mean, pretty small farms. Enterprise size, 94 acres, which is an average. I mean, as I said, we have 4,500 acres, or 7,500, I think is the largest that we have now. Estimated carbon value in tons, the price, average price you can get per ton, the potential carbon value now for that particular asset. So the average operating loan, and then you have the loan to value ratio, which is the same thing that your mortgage, your lender does for you also, your loan to value. Do you want to borrow 90% of the value of your house or 70% of the value of the house, right? That's why we do the 20% deposit or not, right? So we start seeing differences, and based on these differences in that loan to value ratio, they call it carbon backed lending, the bank actually gives a loan at a lower interest rate. And this is aside from the actual credit rating of the farmer. This was first experimented with in the in Wyoming and Montana by First Interstate Bank, which is a private lender, and they did that with ranchers. So the same thing, so bifurcation of loans, so we're doing this as well. All right, so let's go into, so basically, you have it for one farm, but we have thousands of farmers. So basically, what Greenstone does is portfolio loan management, just like your lender does mortgage portfolio banking, right? So they put a whole bunch of mortgages together. The same here. Greenstone pools a lot of their loans to bankers as well. So that all gets rolled up initially into the portfolio of Greenstone. Then it gets repriced by Agribank and ultimately rolls up into the bond. So you sort of have that up and down benefit. And this is just one of the benefits, right? So we're looking at multiple benefits, not just lending, but also the insurance, which is the new piece, right? And then carbon asset, the carbon asset value increase to the farmer as well. Ultimately, the messaging for farmers to be willing to talk to us is not about sustainability. It's really all about how is it going to improve my P&L? How is it going to improve my profit and loss statement? And they're very creative. You talk to 10 farmers, no two farmers have the same way on how they run their operations. Some of them run the farm as an LLC, like an individual property owner, and they put all their machinery in a C Corp. And they pay a lease to the C Corp to use in their operation. So the C Corp, the for-profit company makes money, but the LLC might lose money. So there's like a lot of local optimization between farmers. I mean, you have to think about that. It's not simple. There is no aggregate solution for all, right? We start seeing these multiple pillars and clusters of behavior. Anyhow, so the team, as I said, involves Greenstone. Star of the West is a huge supporter. I don't know if they're part of this group here. So Star of the West is a major off-taker of various different crops in the Great Lakes region. And they also are starting because they have fiduciary duty to report carbon risk to, Campbell and to Walmart and everybody else, so that Campbell and Walmart can get their discounted loans, right? So there's sort of, I mean, all of that is essentially one big ecosystem. So they've been a huge player, and they're trying to also incentivize the farmer. And then, of course, we have FFARM, Michigan Farm Bureau, has been great. I mean, to sort of get farmers to talk to us. And otherwise, there's this company called Triangle Digital, it's a New York firm. They're helping us putting all of that information of these 17,000 farms, and then we have way more of them. It's over 100,000 in the Great Lakes region. And all that data on a single platform. It's hard to do it in an Excel spreadsheet, so we put that on the blockchain for transactions. So I want to leave it at that and take any questions if there are any. Thank you.
I got a question for you.
Time for a couple questions.
All right,
We'll
yes.
take one here and then one over there, all right?
Thank you so much. I'm David Emmerman with the state of Ohio. It's very interesting. I learned quite a lot about the financing. I had no idea about that flow of money and the way you described it. And I don't have any sort of farming background. So I'm curious, as you've done this, you did the conversion from nutrients and fertilizers to the CO2 equivalent. And I think I followed, and that's what the banks want to see as they do these reduced rates. But would it make more sense to, since these finance institutions are farming based, to not do that conversion and look at it purely from a nutrient standpoint and nutrient management standpoint and keeping that on the farm fields and try to get that reduced rate for nutrient sustainability rather than doing this conversion to CO2 and then getting it through the CO2 standpoint?
I mean, one would think that that makes the most sense, except for the regulatory frameworks are not set up in terms of how financing is conditioned. It is still all carbon or carbon equivalents. So we can't get around that. Where it does help is it is going to be in that insurance product, because essentially those will be corporate water quality accounting credits. And those are going to be essentially pools of farmers that will get invested in by, I mean, essentially a corporate insurance product, and the benefit that they get is the reduced run. But that's all accounted for as water quality. But in finance right now, there is no other mechanism. Should there be? There probably should be. There is no other mechanism to keep track of that but carbon or carbon equivalents. But to your point, though, the conversion factors are very dubious, right? So the question is, do you use the conversion factors of the producers? Do you use conversion factors that are being used by, say, water utilities? Do you use conversion factor, I mean, other type of conversion factor? So there has to be an agreement, I guess, there on that. And that's why we listed 3 of them for us to enable to bracket that. But ultimately, there will need to be a standard on how, because it typically is 2 farm gate, right? You got in and out, and then there's the farmer itself. So is whatever stuff that comes off of the farm, is that essentially a continuation of what went into the farm, because it's an over application, and could you therefore use what the European Fertilizer Institute uses as its carbon equivalent conversion, and that's what we've been doing.
Okay, let's take one more over here.
How did your team deal with the uncertainty within the carbon models that you were using? Because it might put out a number, but you could be minus 200 million, pounds of CO2e, or you could be, or tons of CO2e, or you could be plus 8 million.
When you say the uncertainty, I guess that could be there's a little bit of a cascade of uncertainty here, right? But so when you're talking about the total number, I guess that I put up earlier, right, on how much potential carbon is there. Well, as I mentioned, at that time, we did not have individual farmer information yet. So that all we knew at that time was how much of a farm loan is spent on fertilizer. Now, that information is only available at the county scale, or Farm Credit will report it as an average per county, but not a specific per farmer. And that's why now I'm deploying about 15 students to interview all these different farmers. And actually, surprising to us, all of them are willing to give us their accounting or have us talk to their accountant to actually get that information on how to use it. So to continue that question, I know there's another one here, but is that some farmers use wholesale fertilizer. Some farmers apply futures contracts, on fertilizer. So now we have to start sort of teasing out how they're purchasing that, because basically what we do is we convert dollars to pounds, and that to carbon, right? So this was still aggregate as we knew it at that time, just per county. But I mean, that's why we need kind of that digital operational twin to sort of tease that out. And once we know enough, the AI ML models have become so powerful right now that we can start sort of testing it and expanding it, even if the farmers don't give us a full disclosure, just give us acreage, for example. We can actually get reasonable data.
Great, thank you, Peter. Let's give Peter another big hand.
Oh, you're up.